Chapter. We're talking real money.
Hey, welcome to Talking Real Money. Tom Cock here. Don McDonald with the day off and a special guest. You've heard from her before. We're glad to have her back. One of our advisors. We'll talk to her in just a moment. But I'm not supposed to do this. I'm going to get in trouble with Don. But this just came across the wires. Remember that expression, came across the wires? Anyway, about a big bank that advertises a lot. You see them on TV. I don't watch very many ads on TV, but somehow I can't avoid them, maybe because of sporting contests. Capital One. Now, the banks are in the business of making their shareholders money. We should never forget that. Credit unions, you're a member of, so therefore their profit motive is left. But the banks, their job is to maximize shareholder value. And how do they do that? Well, they pay you less interest in many cases. And in this case, kind of shocking, Capital One offered these special interest accounts and then confused you. You put it in the wrong account and you didn't make the interest you thought you were going to. The advertisements say, what's the catch? There is none. That's what the bank says. But there were two types of accounts that they operated. The 360 savings and the 360 performance savings. Now, one had an interest rate of 0.3. Which is, now we've talked about leaving your money at major banks. They don't pay much in your savings account. The other, they were offering at a far higher rate, like 4.5%. But unless you really parsed it carefully, people put a lot of money in the wrong one, 360 savings and not 360 performance savings. Now, the Consumer Financial Protection Board has weighed in on all this. They're suing the bank. They claim this cost depositors more than $2 billion. And this always gets back to how particular you need to be about your cash. Many people just leave money laying around at large institutions. It's in the trillions. They don't pay attention, or they follow offers like this and not really pay attention again to the fine print, which you've got to absolutely 100% do. So, and by the way, Capital One, in their defense, which is the 9th largest bank in the country, so they disagree with the claims and they would dispute them in court. So again, cash, if you're really going to use 3 to 6 months, there's a number of things, but I love a high yield savings account that you can get to the best rates at bankrate.com. Number 2, read the fine print carefully. I don't want you one of those people that would cost billions of dollars. So, and the major banks in a general way don't offer much in the return in sense of interest. They count on you to be kind of lazy, if you will, to sort of leave things as you are. And that is good for them, but not as good for you. So pay attention to these things. All right. Our guest today, can't hardly call her a guest, is someone who's an advisor here at Appella Wealth. We've talked to her many times on Talking Real Money. She does a great job. Roxy Butner, thank you for interrupting the work with your clients to come in our humble studio and spend a couple minutes.
It's my pleasure. We've got some great questions today.
Yeah, we have a lot of questions. You can always ask questions by going to talkingrealmoney.com. You'll see a place you can either do them, I think, by audio if you want to have one for Don, or you can type them out. And boy, some of these are they're lengthy. I'll put it that way. So
yes,
go ahead.
Are. All right. So we'll start with a less lengthy one here so we don't bore everybody. So the first one is from John in Phoenix, Arizona. And he says, "Hello, Don and Tom. I have a Social Security question. You are always saying to wait as long as possible to take it, and I would say you are right if you live past 79 years old. But what about this scenario? Let's say you are in a skilled trade union for the last 40 years and you're retiring with a local pension of $3,000 a month and an international pension of $2,300 a month, a 401a worth $400,000, and an insurance account worth $130,000. So you decide to roll the 401a from John Hancock into a Schwab account that holds SCHD, which is a Schwab U.S. Dividend Equity Fund, AVUV, which is a U.S. Small Value Fund, and AVGE, which is an All-World Equity Fund. And you're thinking about rolling that money into those accounts, not touching it for at least 10 years, and instead taking your Social Security at 62, because you feel like taking the Social Security and not touching the 401 for a long period would be better than drawing down the 401 every year and holding off on the Social Security.
Then he added asking for a friend. I love that. Thank you, John. Great question. Couple of things here that I think you should pay attention to. Number one is the reason that we advocate waiting for 8, that's the expression I use, wait for 8, is because you get basically an 8% a year increase in your benefit for every year you're waiting after age 62, plus inflation, by the way. It's hard to make that in any investments. In fact, everything you read says people make in the 5, 6, 7% range if they're really doing everything right. But you're absolutely 100% correct. You got to live the 10 years after you claim. That's one thing to consider. Number 2 is, and we're going to talk about this at Retire Meet, which Roxy will be speaking at as well. One person I truly believe in your household should wait for that larger benefit. So no matter what happens, whichever party goes first, one of you has that bigger benefit. So in some cases, it might make sense for one party to go ahead and file at an earlier age, and then the other one to wait until 70. I think you're always going to want that larger benefit there. But then you raise this great point. At the end of the day, does it make sense to have the government give me my money back, or does it draw my own money? This is always an argument. And again, the numbers are most of the time going to show that waiting makes more sense. But you got to live that long. If you don't, and there's other factors that we talk about. If you need the money, then you got to go get it. If you have health reasons, or if you have a short lifespan in your family, those are reasons to go ahead and claim it as well. But what's your take here, Roxy?
Yeah, I mean, I think the big glaring item for me is you already have $5,300 of pension income. So really, my big question is, how much of that $400,000, if you did put it into an IRA, would you need to pull each year to supplement your income? If it's a really small amount and you're, less than 4% that you're pulling, then of course it makes sense to wait for taking Social Security, pull that small amount, and then that way later on, not only do you have you have a higher income monthly because your Social Security is higher for the rest of your life, but also you have more flexibility and a larger chunk of money that you can draw from in case something does come up, right? With the $400,000, and that's growing. So you also have to think about flexibility here in the future. You have no idea what your life is going to look like. Maybe you do need to pull a big chunk of money, and it'd be good to have that $400,000 there. Yeah,
I think that's good. By the way, just one add here, John. We do not recommend SCHD. We're not dividend players. There's, again, much argument. You hear all these people, I just want to pay the stocks that pay out bigger dividends. Remember, there's a reduction in price when they pay that out. Remember, there's less diversification when you limit the number of stocks you hold by only getting the high dividend payers, and many reasons why they are, or there appear to be, because sometimes the prices come down. Sometimes they need to increase that for getting people interested in their stock. So we do not invest in a dividend play, as I would say you're doing here. But there's a lot to consider. And by the way, in this situation, great opportunity for a plan where you could really put everything into the software and say which works better. It's not always 70, by the way. Sometimes the plan says go ahead and take it at 67. But wait for 8. That's my new expression for this year, and I'm loving it.
I like it. Okay, next question is from Dustin in Stevensville, Montana. I have a PERS, Public Employees Retirement System. I have money in Corebridge, some money in a traditional IRA, and some in a Roth IRA. I am curious about your opinion on using the traditional to buy some retirement years to add to my PERS pension. I know the Roth is taxed before it is invested, but the traditional will be taxed when I start pulling funds out when I retire. I am leaning towards rolling it into my pension and buying another year of service.
Yeah, this is an interesting question because there's a couple of things to consider. Obviously, you've got to consider all the numbers, right? How much of that savings do you have to put in there to buy that additional year? You got to run that number to see if it makes sense. But I think bigger than that is the fact that you lose the liquidity, because you just said something very important, Roxy. In retirement, sometimes people come along and there's health things or other aspects of your life that require a chunk of money. If you don't have that, if you've already, in many cases, we've told you don't necessarily buy down your mortgage because of that for other things. But in this case, you bought more pension, so you have more income, but you don't have liquidity. I will say this, for people that are nervous about investing in stocks, this can be a good idea because it reduces the anxiety in retirement, watching your portfolio go up and down. Instead, you're getting this regular income. But you got to apply all the other rules that apply to pensions. Is it going to be single life, or is it going to be a survivor benefit? Is there a COLA involved? All those other things you would consider anyway would have to go into all that. But I would rate this close generally when we look at the situation. And again, around your personal makeup emotionally would be helping me to make that decision. But what's your take here?
Yeah, I mean, I think you can absolutely run the numbers, right? So this really depends on how many years would it take to kind of break even. So let's say, I'm just throwing numbers out here, but let's say you need $10,000 to buy 1 year of service. So you take that out of your traditional IRA. How many years of that additional pension income would it take to get that back? And then compare that to leaving the $10,000 in your IRA growing at, I don't know, 5, 6, 7, 8%, whatever number you want to use depending on your allocation. So in the end, the taxes don't matter as much. Both your pension income and your traditional IRA distributions will be taxable. But yeah, I would run those numbers if you're kind of on the fence. But I agree with everything Tom is saying. Some people just really prefer that monthly income. But I do think having some liquid assets in retirement is extraordinarily important, more important than people realize.
Yeah, they don't know it until they face it. And the other thing is, again, when we look at sort of the pensions and versus the investments have a tendency to grow faster than the pension benefit does, because investments, again, depending on the allocation, have a tendency to go up faster than just a cost of living increase. So something to think about there. Not one right or wrong answer. And again, the emotions, your emotion, who you are is important as well.
Okay, then we have a question from Ken in Denton, Texas. And he says, Merrill Edge classifying AVGE as this security is currently blocked and unavailable for trading. Why would they block this ETF that you suggest so often?
I don't know the answer to this. AVGE is the Avantis Global Equity Fund. This is an exchange-traded fund where you buy the globe. You have some of the factors that we think you should have in there, small value, parts of the market that many of you don't own enough of. AVGE does this very nicely in one fund and does it at a relatively low cost. But I couldn't tell you that. Did you get a chance to look into it?
I did look into it a little bit, and it just turns out that Merrill is pretty restrictive on multiple ETFs. So AVG is not the only one. Apparently, the ARK fund wasn't available for a while, then it became available. But it is unclear when people try and call them and ask. They don't get a clear reason as to why. I mean, there's a few arguments. I mean, you could argue that they, want to kind of push you towards purchasing some of their own funds or funds that they might be affiliated with.
You're too young to be that cynical.
Other people are thinking that maybe they're just cautious of, allowing certain funds that have lower trading volumes or newer funds.
But they couldn't call this too risky. I mean, there would be people that wouldn't allow things like IBIT because of the cryptocurrency. You could say that about that security. But in this case, if they're classifying it that way because they feel like there's too much risk, I think that's a poor decision. So it sounds like, and maybe, by the way, maybe they have some minimum amount that they want in that fund or a track record of some kind before they're going to allow you to trade it.
Yeah, it seems like one person had even mentioned on Reddit, actually, that...
Which is, that's a very good source of financial information.
But no, they mentioned that they couldn't even purchase a Vanguard Ultra short-term bond fund. So what would be the reasoning there? I mean, that's definitely not risky. So it's interesting. There's not a clear answer. I would say Merrill Edge is...
I think there is a clear answer. Don't have your money at Merrill Edge.
Yeah, it's exactly what I was going to say. Wouldn't be my top choice.
No. And by the way, thank you all for... We've gotten so many questions at the beginning of this year. We're trying to catch up. We take them one at a time, but we also try to take them in order. So keep them coming. TalkingRealMoney.com. You can send us in whatever you want to know there. So go ahead, Roxy.
All right. We have a question from Rick in Hot Springs Village, Arkansas. He says, I retired 5 years ago at age 48. Good for you.
That's awesome.
I plan on taking Social Security.
That's going to be what you end up doing. You're going to end up quitting at 50.
I hope so. Not if I try to buy a house in the Seattle market.
That's true. You may be not coming out of the house a whole lot. But anyway, so go ahead.
I plan on taking Social Security at 70. Given my age, that means the Social Security Trust Fund will run out of money before I start.
All right, I'm going to stop you right there because run out of money is, even under the worst circumstance, it doesn't run out of money. It can only fund about 80% of the benefits it's supposed to pay out, and that's in 10 years from now. So that's one I'm going to take a little bit of umbrage with right off the bat, but go ahead.
My question is, does the Social Security estimate of benefits take this potential decrease into account and show me a lower number? Or should I discount their estimate by approximately 17 to 20%, the often cited projection of the yearly shortfall? I understand this may change if Congress decides to act.
Yeah, this question comes up. It's one of the main reasons that so few people wait till age 70 to take their Social Security, which is still like 5% of America. A lot of it's like 40% take it at 62. Many people still take it before full retirement age. I don't want to wait because the money's not going to be there. I've been told by Don specifically not to guarantee that it will, so I can't guarantee that anymore. I think it will be fixed because so many people are so reliant on it. But so what should you do if you're 48, you're planning on taking Social Security at 70? Here's my view of taxes, of benefits, of all these things. Take them as they are today, because the minute you start to say, well, wait a minute, this could happen. Well, that could, but something else could happen. The supposition will lead you down a path that you may not want to go. So I take everything I take. And there's been all kinds of years where people said, wait till next year when tax law is going to change, and then it didn't. Or wait till next year when interest rates are going to do this, and they didn't. Take things as they are today. So that's one. And then the other one is Social Security is for people who are, especially at 48, should only be a part of your retirement. It shouldn't be all of it. And if you're retired at 48, I imagine you have other savings, but it should be a part of it. And would I plan on it? I definitely would plan on it. I think in the longer term, I've said this before, there may be raise the cap on Social Security in terms of the taxation. We've come out in favor of that as a way to fix things pretty easily. But I think for people of your age, Roxy, you may have to wait a little longer because people are living longer. But when you're making a plan for somebody at age 50, do you use Social Security as it is today?
Well, one thing that people really forget to consider, and I'm sure maybe Rick has considered this here, is that your benefit that you receive from Social Security Administration assumes that you continue working and earning that income until you claim benefits, or at least until full retirement age.
FRA,
and full retirement age. So there is oftentimes when you want to retire early, people don't realize, hey, I'm not going to get the full $3,000, for example.
That's right.
And then they're surprised when they only get $2,500 because they retired so early and had, X amount of years with zero income. So there is a resource on their website where you can go in and manually put in my age, what my income will be from 48 to 67.
This is at ssa.gov?
Yeah, I've done it manually for folks. So you go in and put $0 of income for those however many years, 10 plus years for him, and you can recalculate it to see what your income will be. And so I highly, highly recommend you do that so you have an idea. Yeah.
And again, let's wait. I wouldn't go out and change anything in my retirement plan today based on where we are with the Social Security not running out of money, but not having enough to fund it in about 10 years. By the way, I'm already past full retirement age. I told that to somebody the other day, and they started escorting me out of the building. It made me kind of nervous. I was like, that doesn't mean you have to quit or something. But anyway, so thank you for the great question. All right, we got one more, which is a bit of a tome, but we'll see if we can get through all of it.
Yes, I'll try and kind of, shorten this here a little bit. So this is from Mike in Georgetown, Ontario. So our Canadian listeners. And he said that the first little section that he has here is he's looking for how to watch a awesome documentary that Dimensional Fund Advisors put out called Tune Out the Noise.
Which is very, very good. I think anybody who is an investor should see it because it tells you a lot about this industry and all the things they're selling you and what you should believe. But I'll go ahead and answer that because you do have to go to one of the firms that works with dimensional funds. It's not available to the public. You can't just go find it at Netflix or something. You do have to go to a firm. You could call us, for example, and we could find a way because you do need a login, I believe, to get to it. But it's available. So if you called our office and asked for myself or Roxy, we'll find a way to get you behind that sort of firewall so you could watch it.
Yeah, I believe there's an access code. So we'll just have to reach out to our dimensional folks and see if we can get that. So then he goes in to describe his situation a little bit. So I will read this. So my wife is 35. I'm 40. Both work and are in the middle of our accumulation phase. She has a defined benefit pension, and I have a company match to a retirement account of 5% of my annual salary that I take advantage of. We have an emergency fund, and we each have a brokerage, a retirement account. They have an RSP,
which is similar. Yeah.
Similar to an IRA in Canada, and a TFSA, which is similar to a Roth IRA.
Yep.
Our kids are fully set up with funded education accounts, and overall, they're about 90% equities in all accounts, which, going back to their age, 35 and 40, depending on when they want to retire, I think that's fair. I think over time, they'll probably want to add bonds, which he does mention doing. And then he says small allocations to PDBC, SHY, and hard assets just for flavor and a glide path to increase towards retirement.
Now, those are
60s.
Things like gold, right? Or
commodities.
Yeah, commodities. And we do not specifically invest in commodities. We end up owning companies that are involved in the commodity trade, if you will. But commodities, again, if you look at them long haul, they're more about sentiment than they are necessarily about the asset. And they're more related to inflation. So they've made about what inflation is over time. People like them because they feel like that's a hedge of some kind. It hasn't proved to be a hedge, but we would not recommend you hold those in your portfolio.
And it looks like he has about, overall, he lists 7% in commodities, 3 different types of funds. And so he says they have $1.4 million overall, which is great for them at that age.
Absolutely.
Allocated 75% U.S., 17% developed international, and 9% emerging markets, with a shift to small cap value.
Let's just stop them right there, because you're overcommitted to emerging. You're a little undercommitted to the U.S. versus the rest of the globe. A little, not dramatically. Again, if you walked into our door today, you'd be at about 65% U.S. and 35% international. I happened to look it up because we had a lecture from Apollo Lupescu this past few days. Their global fund is 75-25, which is fascinating. But even in that, your amount that you have in emerging markets is a bit high when you relate it to developing markets. It should be more like, I think, a third or less of the overall international makeup. Yeah, so you're a bit overcommitted. And those are riskier places. Hopefully they make more. They haven't really since the Great Recession, but those are developing markets. So, so there'd be a little bit of work to be done there, but it wouldn't be huge, I don't think.
No, I don't think so. And so then he goes to list off some specific ETFs that he has to get this balance, right? So he has VVL, which is a Vanguard Global Value Fund, AVUV, which is a Avantis Small Cap Value Fund, I believe.
It is.
AVDV, which is another Avantis Value Fund. And
so
then
there's a bit of overlap there. I mean, and this, this concerns me because oftentimes people have a series of ideas in their portfolio. Oh, I heard you talk about that. I got to have a little of this. I don't know that you need all those funds. You could divvy this. There's a couple of ways you could go here. You could just have a global fund that holds all those things, or you could have a fund that's, large U.S. growth kind of companies, small U.S. value kind of companies, and then do the same thing internationally and cover it a bit better than having this overlap you have here.
Yeah, and a lot of these are value funds, which we love value, but you might be a little overweight to value because of that reason.
I think you're right, yeah.
So it's important to keep note of that. So he basically is asking if he has a hodgepodge, which a little bit, but not too bad. And he says his current mix... he's 75 on the risk quiz, and his wife scored a 70. So touching on risk tolerance a little bit, they're at about 90% stocks, but they're, mid to late 30s. So I think that's fair. And he does say that with new money, that's how they're rebalancing, right? So they're contributing to the accounts. About 10% of their monthly salary goes to all of these accounts. And they use that to either add bonds over time, add some international or small cap value, which I think is a great approach, right? You're cost dollar averaging into the market, using that as an opportunity to rebalance.
Yeah, and you might want to go to Morningstar and just plug in these funds just to see what your overall large to small growth to value ratios are. Another thing to think about here, because he didn't get into it very specifically, is asset location. So if you're going to start adding bonds, I would want to add those in the pre-tax I think it's
RSP.
RSP, correct. And then adding the stocks to the TFSA. Wasn't that a TFS? So, I mean, you want to have asset location, especially you're so young when you're saving all that money, you're going to get the tax benefit of doing that. And I would not be, because you've already sort of had this dalliance with gold, et cetera. That's fine. I would not add to those positions. And gold had a very good year in 2024. No idea what it's going to do this year. But again, over the long haul, it's kind of kept up with inflation. So I wouldn't be running out and buying a whole lot more of that.
Yeah. Yeah. And I mean, basically, he's just asking, how's he doing on this? And the only other thing he mentions is no other debt except for their mortgage. And I will say, with 1.4 million saved at this age and with the 10% of your income going into these accounts, a little bit of cleanup on the portfolio. As Tom mentioned, you can find websites where you can plug in the exact funds and how much is in there, and it'll kind of give you a summary of your overall allocation. But you're on the right track. So
now, one thing we didn't ask, is that 1.4 million Canadian? So that's like $4 US. I'm not kidding you.
I just went up to Canada, and I was really appreciating that exchange
you
rate.
loving some US dollars there, right? So it makes sense. All right, those are great questions. Keep them coming to TalkingRealMoney.com. Before we let you get away, thank you very much for your time here. You're going to be speaking at Retire Meet, which is just around the corner. What are you going to be? What's the message that day to people who attend?
Yeah, so we're going to be talking about empowering the next generation of investors. And so we'll be touching on, whether you're a grandparent or a parent or an uncle or an aunt, or, you have young ones that you want to help educate them, help set them up, because oftentimes they're not thinking about retirement at that age. What are the options? What are the things that you can do, whether that's setting up a Roth for them or, a custodial account, and how to teach them about compound interest and investing. 529s for education. There's lots of options. So it'll be good.
I love the 529s too, because then if they don't use that for college or for any higher education needs, they can put that in their Roth. What a huge advantage that is.
No, it's great.
That's good. So we look forward to that. You'll be there on February 8th. And for those of you outside the Seattle area, the Seattle program is basically sold out, but you can join us virtually. They go to retiremeet.com. There's a nominal $5 charge. That money goes to the organizations that are involved in financial literacy. So hear from Roxy. I'll be there. Paul Lupescu, who is wonderful, who just delivered a terrific talk to our clients here recently, who really does a great job of sort of walking through what you should pay attention to and what you shouldn't. All of that one day. One place, one channel. Go to retiremeet.com. You can register for that. Roxy, thank you as always. Good luck on the house search. Roxy's been looking for a house for a long time and had a few struggles.
It's tough.
I know.
It's a hard market out there.
It is. It's not an easy time, and rates are kind of high. Anyway, we won't want to get too far into that, but it will happen. And if you want to join us for retirement, we'd love to make that happen as well. So go to retiremeet.com. Anything else? Go to TalkingRealMoney.com. Thank you very much for joining myself and Roxy. We're going to leave you now, but you can be sure of one thing. We'll still be here talking real money.
We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. Providing personalized financial planning or investing advice takes time, so please consult with a really good fee-only fiduciary investment, tax, or legal advisor. We know a good one. Investing must always involve risk. In other words, you can and probably will lose money at times. Also, as much as you want it, no one can accurately and consistently predict the future. So past performance doesn't tell you a darn thing about what the future will bring. Unlike many other programs that say something similar, Talking Real Money is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Apella Capital, a fee-only registered investment advisor. Thanks for listening, and please visit TalkingRealMoney.com for more information and disclosures. That should keep the lawyers happy.